Good day, fellow investors. Last week we discussed Starbucks, whether it is a great business at a fair price, and there were many comments discussing how you need a similar video for Nike, and so many of you liked those comments. So I said, I have to check into Nike to see what's going on. Let's go immediately there. I see there has been a lot of destruction there. This is almost 50% down since everyone wanted to change their life and start training, and those expectations falter a little bit. And now we have to see whether at this market cap, at this stock price of 90, Nike is a buy or not. We have discussed Nike there in 2020, and I must say I didn't like Nike that much because a little bit too risky. It went up much higher from where I didn't like it already, but then it came back. However, Adidas did really good over the last year and a half, almost 50% up compared to Nike going down. And I even told you a year and something ago that at this price, this 115 for Adidas, you will likely make money by buying at that point, but those shoes were really incredible to buy. However, the stock went up, so that's what's going on. Let's dig deeper into the numbers and then put those into a categorization. What kind of stock to buy could those be? A relative, an absolute, and then an absolute margin of safety value investment buy. Let's immediately start with Nike, and I looked a little bit at the last quarter earnings, and I see that things are not as great from a growth perspective. So slightly up. When company starts to say slightly up, then you know it's not really growing. Decreased 3% on a reported basis, 4% on a currency neutral basis. Selling and administrative expenses increased 7% on no increases in revenue. And there is the talk, we are making the necessary adjustments to drive Nike's next chapter growth. There is some shareholder reward, of course. The quarterly dividends and repurchases are there. So they are repurchasing, continuing that program. More is still left, approximately 10 billion to reach, and 10 billion is always a nice push for any stock. I have looked a little bit into the conference call, and you see that it is all about what can they do to drive Nike back to growth. It's all about growth, especially when you have a P ratio of 30-40, it has to be about growth. And then you read a little bit about what the management is doing. Olympics, Paris, they all try to innovate with Air brand and their focus, but when they discuss it, they don't really see growth getting here fast. So we continue to expect revenue to grow approximately at 1%, and then going forward, somewhere in the future, they expect things to improve. And then if I look at what they're talking, this is the core focus, scaling newness and innovation. That's the big words that the management is using. And then, of course, good questions by analysts. How do you think you will transition that to the next chapter of growth you cited? How will that work? How can we model that into our earnings models? That is what the analysts want to know. But apart from big word and big, maybe past brands, I just put Air into search on the conference call transcript, and they mentioned Air 47 times. Once was some airbag or something, but it is mostly about Air, and Air. And then again, on pricing power, how are they going to work on that? And the key question there, on their innovativeness is just growth. Growth, growth, and then I'm thinking as an investor, yes, growth, but what if there is no growth? What if the structure of the market has changed? What if there are no more penetration? Or people are buying, I don't know, barefoot shoes, this and that. There is so much supply that you don't need to buy more of the Nikes, especially maybe not at those prices. Hokas, this left and right. People are buying a lot of the other brands, and maybe there will not be growth anymore, because I'm looking at their financials a little bit, and from 2022 they did still grow, but then last year it has been stability, and you're not buying stability at a P ratio of 26. And then on their innovativeness and the Air brand, I'm sorry to say that, but Mike is now 61 years old, and maybe he will kill me for saying this, maybe he can't dunk anymore, which is a big risk. No, the risk is not Mike dunking or not, but it is risky to check a company at a P ratio of 27 expecting that things will turn around and start growing. If I look at estimates, if I look at the next 1, 2, 3 years, don't look at this because those are just a few analysts estimating that, then still estimates 4.5, we are still in a P ratio of 20 range. Even if they manage to grow 14%, 8%, and 15% going forward, thanks to the buybacks and who knows what. But still, that leaves us with a forward P ratio of 20, with usually what is very, very positive analysts' expectations. They are doing their buyback, so okay, there are the dividends, so there is something. However, if I look at Nike and discuss it from a buying perspective, relative buy, no, it is as expensive as the market and it's not growing. So the market isn't growing also, as we discussed yesterday, but it's not. Absolute, I'm getting a 1.6% dividend. I'm getting some buybacks, but there is also a lot of dilution there for shareholder rewarding, so no. And 50% lower, maybe then could be some value on the brand, but this is the past. Yes, it is Michael Air Jordan, but too risky for me. And you will see now something else. Let's discuss Adidas. So it boomed since we made the last video. Things haven't changed much, but this is already the first start. The market cap was 20 billion euro here, and then you're thinking, okay, is the brand valued 20 billion? Okay, then there you already have close to a margin of safety, but with Nike at 120 billion, that is much, much more difficult to sell such a brand. Adidas revenues have been stagnating, net income went negative, but they performed better than expected in, again, transition year, and better than expected meant that the stock went from 90, 100 to 200 for a great return. Revenues, North America negative. That's also something very important to discuss here. With these consumer preferences, investments, you never know whether this will translate here and here and here and here. Here they are hot, growing, maybe somewhere else won't be that hot. So you never know, and that's a very, very difficult business to be in the consumer preference and spending, etc. But they accept that they will grow at least 10% in the second part of 2024, and if they deliver that, then they will adjust for the market's expectations of growth. This is already priced in the stock price, I think, now. So if they don't deliver, then it will be a risky thing. But everything will improve because they are transforming the company. They are closing those brands, those bad shoes that we discussed for various reasons. But if I look at this, even if they grow 10% and on that 2 billion, let's say, net income that they have the potential, as we have seen here, that they have the potential to make 2 billion, 1.5, okay, with growth, that's the earnings potential that Adidas has. Now, not much more. So 2 billion is the max, and then you look at this, they are already priced for a P ratio of 20 if they manage to deliver on the expectations. Of course, a year and a half ago they were priced then at a P ratio of 10, which would make it a buy. So when it comes to Adidas, it is not a relative buy now, it's not an absolute buy, I'm sorry. And it's also not a margin of safety buy, because maybe at 50% down it could be. Negative perspectives here have been often right with these negative perspectives. It will depend all on the market. I think Adidas is up because everything is up in Europe, because everyone expects low interest rates and the market to be flushed with money. And in the US, people think that a strong brand will remain a strong brand forever. It might happen, okay? It might not happen. We are a value investing channel, so it's not worth the risk. I'm sorry, guys. Starbucks looks much better from that growth perspective.